Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss the top 5 tax strategies for wealthy Canadians. Specifically, I'm going to chat about 5 strategies to get the most out of your money while keeping CRA out of your pocket, how to optimize your corporate investment account, managing multiple sources of income into a unified retirement income plan, optimizing investments within your investment accounts, and lastly, as always, a few action items for you to consider. Well, I hope you're all having a great day so far, and I hope it only gets better for you as you listen to my podcast and discover a few strategies that we review and implement with our clients in our practice. Your biggest opportunity as a Canadian investor is tax efficiency. In other words, it's not how much you earn, it's how much you keep. I have found that tax planning, specifically tax minimization, is a serious pain point for Canadians. And I know this sounds like I'm stating the obvious here, but you would be surprised how many new clients we meet with and implement what would be considered basic strategies that have simply been overlooked. Whether that be because they are DIY investors who just didn't know, or a family who works with an investment-only advisor who doesn't provide any guidance when it comes to tax. Whichever camp you find yourself in today, I think you may just learn a thing or two. So to get right into it, these 5 strategies will apply to most all Canadians who have amassed a sizable retirement nest egg. Number 1, how to use your corporation for income splitting and investing retained earnings in long-term investments. Now, this one is specific to incorporated professionals and business owners. But hold on, if you don't have a corporation, the balance of the strategies discussed are still very relevant to you. The first thing to be mindful of if you have a corporation is tax on split income rules, sometimes referred to as TOSI rules. In very general terms, the TOSI rule is set up to align corporate income splitting with similar rules used to dictate income splitting for non-corporate individuals with registered pension income. If you are still operating your business, you could consider paying a spouse a reasonable salary or dividend if they are actively involved at some capacity. Further to this, you may also consider distributing income to adult children who have specific rules or duties within the company or have specific shares. By using reasonable salaries for family members who are performing services in the business, you may be able to draw funds out of the corporation at lower personal rates, and in turn, lowering your household tax bill. If you choose to go this route, be sure you have proper documentation and consider the timing of this income. When you pass age 65, TOSI rules no longer apply, and you're able to income split with your spouse regardless of their age. This is a crucial planning point when it comes to your decumulation and retirement income strategy that must be integrated into your overall tax plan. When we come across scenarios with incorporated individuals who also have registered investments, we are able to provide tremendous value helping them to reduce their lifetime tax bill, optimize government pension plans, and create a steady retirement paycheck from all their sources of income. In English, you want to create a retirement income plan that considers all your sources of income, both personal and corporate, and utilize income splitting and tax minimization strategies when possible. After income splitting, let's now discuss investing retained earnings in your corporation. This is assuming these are excess funds that have paid the small business rate, but aren't being used for reinvesting into your business expansion. In this case, when you have accumulated excess funds inside of your corporation, the goal here is to now grow wealth inside of your corporation and not let it sit idle. The first consideration will be utilizing a corporate investment account that is separate from your operating company. Specifically, I'm referring to utilizing a holding company. This helps to separate excess funds from your core business and potential liability, while keeping your books clean in the event you eventually want to sell your business in a share sale, and ensure you qualify for the lifetime capital gains exemption. If we now assume we have your corporate investment account separated in a holding company, what are the tax considerations you need to be aware of? Well, first you need to understand that all passive investment income earned in a corporation is taxed at the highest marginal rate, and in many provinces exceeds 50%. With that in mind, you want to utilize investments that focus on capital gains and dividends. Second, you want to be mindful of foreign dividends, as they are subject to a foreign tax withholding that drives your tax payable on these distributions even higher. Third, if you are still operating your active business, you want to try and keep the passive income generated in your holding company below $50,000 if possible. This is called the passive income rule, and if your passive income surpasses this amount, your operating company will start to proportionally lose the small business limit of $500,000. To help address these 3 points, you will want to utilize Canadian domiciled investment funds that utilize a corporate class structure or focus underlying investments on deferred growth strategies. Both allow you to better control the timing of distributions, and they would be considered a preferred capital gain. In my opinion here, I would lean towards a low-cost solution versus a corporate class solution for a number of reasons. Primarily due to the cost associated with corporate class holdings, how they are structured, and the potential they have to unwind and become very tax inefficient. But we won't get into the weeds on that one today. One last thing I will note here regarding corporations before we switch to strategy number 2 is the utilization of notional accounts within your corporation, specifically the capital dividend account. When you trigger a capital gain, a portion is taxable to the corporation and the other portion is a credit to the capital dividend account. This is a notional account which then allows the shareholder to distribute a tax-free capital dividend free of personal tax. Because this is a notional account, the value gets eroded by inflation each and every year. So utilization of the CDA should be optimized to get tax-paid dollars out of the corporation. This is especially important if the TFSA accounts, for example, are not maximized in your accounts personally. Be sure to review your CDA balance and speak with your accountant about filing the required paperwork to draw down your CDA account when it is optimal. Now, admittedly, tax planning for a corporation is not easy to understand and implement. And while I have a strong understanding of how to build client portfolios, income split, and optimize notional accounts in a corporation, I am not a CPA, and I do not file corporate tax returns. In our client relationships, we work hand in hand with clients' corporate tax advisors year over year to provide documentation, feedback, and overall collaboration to ensure the best possible outcomes for our clients. Okay, so if you don't have a corporation, thank you for sticking with me on that. The balance of the strategies I will discuss do not include the use of a corporation. Strategy number 2, proper use of the TFSA and how the wealthy maximize this account. I think this strategy is so important that I did an entire episode on it a little while back. Now, while the dollar amount of your TFSAs may only be a fraction of your overall wealth, don't underestimate the power of these accounts and the impact that compounding can have over time. First off, this is not a savings account. Now, while you can hold short-term investments and high-interest savings in this account, the truth is that for many affluent Canadians, the TFSA will likely never be accessed for income needs or make up the need for lump sum purchases. So if that's the case for you, the difference between maximizing this account annually and earning, say, 3% in interest versus, say, 7% in a diversified equity portfolio over a 10, 20, 30-year time span is tremendous. In a very simple example, say today you and your spouse had $200,000 combined in your TFSAs and contributed $14,000 a year to top up these accounts. In 20 years, at 3%, you would have around $775,000. And at 7%, you would have $1.23 million, nearly double. And the best part, that growth is 100% tax-free. When it rolls over to your spouse at death, tax-free. When it goes directly to your adult children at last passing, tax-free. Strategy number 3, drawing down your RRSPs earlier, not later. We call this your decumulation strategy. In other words, how do we best withdraw funds from your RRSP and RRIF accounts over time to minimize your lifetime tax bill, maximize your government pensions, and create a sustainable retirement income for life? The goal of drawing down from these registered accounts is to withdraw at a lower tax bracket and smooth income before age 71, when the RRSP account must be converted to a RRIF. We call this time before age 71 the tax valley. This is a period of time where we can make some great planning decisions that will have a positive ripple effect throughout the balance of your retirement. It really is a crucial transitional period for retirees. And when done correctly, we can protect and maximize government benefits, keep CRA out of your pocket, and mitigate the RRSP tax bomb that can happen at last passing. To implement this strategy, you need to think about timing, marginal tax rates, other sources of income, potential inheritances, and more, not just deferral. Strategy number 4. Structuring your portfolio for tax-efficient income using capital gains and dividends. Not all investments are taxed equally. Interest income is taxed at your highest marginal rate. Dividend income is more favorable, especially eligible Canadian dividends, and capital gains are only taxed at 50% of your marginal rate. The investment you hold will dictate what kind of taxable income you are creating. In very general terms, in your non-registered accounts, you want to focus on tax-preferred capital gains and dividend investments, while in your RRSP and RRIF accounts, you would want to lean towards interest-earning investments. When it comes to a tax-efficient portfolio, it's not about what you invest in, but where, how, and when you draw from it. For more on creating tax-efficient portfolios, check out episode 33. Lastly, strategy 5, smart ways to support your family or causes you care about while keeping more money out of CRA hands. Estate planning is a crucial part to your overall tax plan, and it's why we include it as part of our fundamental retirement plan process. How do I pass wealth on efficiently? How do I support my children or grandchildren without triggering tax traps? How do I leave a lasting impact while giving as little as possible to CRA? When it comes to keeping CRA out of your pocket, here are a few things you can consider to help answer these questions. First off, consider gifting during your lifetime. If you find yourself in a position of abundance, you may want to consider gifting your beneficiaries today rather than in your estate. This may help to lower your taxable distributions year over year as you decrease your overall retirement nest egg, minimize the amount of assets that may flow through your estate that would be subject to probate, and lower your final estate tax bill in the process. Another consideration is utilizing trust structures or family loan arrangements to maintain control and protection while shifting tax away from your hands personally. Another option would be to utilize insurance, especially if you have a corporation to offset future tax liability. Now, this strategy is quite complex, and admittedly, it is pushed very hard by advisors based on the commission they receive upon selling such products. That said, there are some scenarios where utilizing insurance does add value. If you have charitable intent, another strategy includes gifting a stock or investment directly to the registered charity in kind. And when done properly, you or your estate will not pay the tax on the capital gain. The charity gets the full amount of the gift, and you or your estate receives a tax credit for the full market value of the shares. Lastly, you need to make sure this is all documented properly through a well-thought-out estate plan. This includes documents like wills, powers of attorney, shareholder agreements if you're incorporated, and much, much more. Whether you're an incorporated entrepreneur, a high-income earner, or nearing retirement with significant savings, these tax strategies could help you keep tens or even hundreds of thousands of dollars more in your pocket over time. If you find yourself in a position where you have multiple accounts, large pensions, holding companies, and more, I urge you to build a team around you that includes a certified financial planner who understands tax and can build a long-term plan to lower your tax bill, an accountant who can file properly and do the best they can each and every year, and a lawyer who can put all the legal stuff together so things don't unwind when things get tough. Okay, so that'll do it for today. Here are your action items for today's episode. First off, if you do have a corporation, ask your accountant what your capital dividend account balance is. If this number is high, speak with your accountant about filing the forms to have this drawn out and then invested in your hands personally. If you don't have a maxed out TFSA, this is a no-brainer. Review the investments in your non-registered account, in your corporate account, in your personal account, or both. How are these investments taxed? If you don't know, be sure to consult your trusted professional to ensure you aren't overpaying tax to CRA. And lastly, if you've learned something today, do someone else a favor and share this episode or podcast with them. Maybe they can learn something as well. Okay, so that'll do it for you today. Make sure that you add us on all your socials, LinkedIn and Facebook. If you're enjoying the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure you're signed up for our weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.